Hi, I'm the Tax Geek, and here are more of your taxes oversimplified. In this video, we're going to take a look at the Retirement Savings Contributions Credit, otherwise known as the Savers Credit. The Savers Credit gives an additional incentive for low to moderate income taxpayers to save money for retirement. The credit can be as much as 50% of the first $2,000 you contribute to a retirement plan, depending on your adjusted gross income. The credit is non-refundable, which means it is limited to your tax liability, less any other non-refundable credits, such as an education credit. The credit is calculated on Form 8880, and the amount is transferred to Line 4 of Schedule 3 and then to Line 20 of Form 1040. Here are some advantages the Savers Credit offers. The credit allows you to double dip, so if you contribute to a 401k or traditional IRA, you not only get a reduction in income tax for contributing, but also an additional tax credit. Here's an example. Mark is a single taxpayer and his salary is $27,000. He contributes $1,000 to his 401k plan, reducing his taxable salary to $26,000. Which gives him an immediate $120 tax savings. But he is also eligible for the Savers Credit, which in this case gives him a tax credit of 10% of his contribution, or $100. So, for his $1,000 contribution, he receives a $220 tax benefit. Another advantage of the credit is that it gives you an immediate tax benefit when you contribute to a Roth account or make a non-deductible IRA contribution. Here's another example. Gordon and Susan filed jointly as a married couple. Gordon has wage income of $42,000 and Susan is a homemaker. Gordon makes Roth IRA contributions of $1,500 for himself and $1,500 for his wife. In this case, the total contribution of $3,000 would be eligible for a 20% tax credit, or $600. And finally, the Savers Credit is one of the very few tax credits that married persons filing separately can receive. Let's look at Matilda. Matilda files separately from her spouse and has an adjusted gross income of $23,000. She made a $500 contribution to a traditional IRA, but she wasn't allowed to deduct it. However, she is still eligible for a $50 Savers Credit. The percentage of your contribution to calculate the credit is different according to your filing status and adjusted gross income. Here are the qualifying income ranges to receive the credit for 2021. Here is a bit more information regarding the Savers Credit. The credit is not available if you are under age 18, someone claims you as a dependent on another tax return, or if you are a full-time student. The contributions eligible for the credit are reduced by any distributions you made from any retirement plan in the 3 years before the current tax year. Here's how that works. Let's look at Mark again. In this case, he took $750 out of his 401k 2 years before. Therefore, only $250 of his contribution would be eligible for the credit, so his credit would be just $25. So that's what most people need to know about the Savers Credit. If you'd like more details about the credit, additional resources and links are in the description. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. If you have any questions, comments, or suggestions for future videos, please leave them in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.